When you look at a company's financial statements, it can feel like you're trying to crack some kind of secret code. But there's a key, one number that tells you the real story of a business, and that's cash flow. So today, we're going to be financial detectives. Our one and only mission, follow the money.
So let's start things off with a little mystery. A company can have an amazing product. They can be making millions in revenue and still be teetering on the edge of collapse. On the flip side, a company can look like it's losing money on paper but actually be incredibly strong. So the question is, how do you tell the difference? How do you really know if a company is healthy?
Okay, take a look at these. We've got snapshots from 3 huge well-known companies, Walmart, Uber, and the once great Sears. Now notice something interesting. They all ended the year with more cash than they started with. But here's the catch. Only one of them is actually healthy. So just based on these numbers, who would you bet on? Go ahead, lock in your answer. We're going to reveal the secret at the end, and I promise you it is all going to make perfect sense.
To solve our little puzzle, we have to look past the headlines. You know that number everyone talks about, net income? Well, that number can be massaged with accounting rules and different estimates. But cash, you can't fake cash. It is the absolute lifeblood of a company. It's the real money moving in and out, the stuff that pays employees, pays suppliers, and literally keeps the lights on. That right there is why cash is king.
Let's make this personal for a second. Think about your own money. Your salary, that's like your net income. It's the official number you earned. But your cash flow, that's what's actually left in your bank account after you've paid rent, bought food, and paid all your bills, right? You can have a huge salary, but if you're spending more than you make, you're in deep trouble. Well, guess what? Companies are exactly the same.
So the statement of cash flows is broken down into 3 main parts. We're going to start with the most important one, the real heart of it all, cash flow from operating activities. I like to think of this as the engine room of the company. It answers the most basic, fundamental question of all. Is this business actually making cash from its main business?
So what does that mean exactly? Well, simply put, operating cash flows are the cash that comes from the main thing a company does. For Walmart, it's selling stuff. For Uber, it's giving people rides. This one number tells you if the core business model is actually working and if it's sustainable. A big, positive operating cash flow, that is one of the best signs of a healthy company you can find.
Whoa. Okay, I know what you're thinking. That formula looks intense. But seriously, do not be intimidated by this. The indirect method, it's really just a logical puzzle. We start with net income, which we already know isn't the whole story. And then we just make a series of adjustments to take out all the non-cash stuff. It's like we're translating from accountant speak back into plain English to find the real cash.
All right, let's actually put this into practice. Let's roll up our sleeves. So, imagine a company, ABC Corp, reports a net income of $290. Looks fine, right? But what's the real cash story? We're going to use that method we just saw to adjust this number and find out exactly how much cash their operations really brought in.
Okay, let's walk through it together. We start with that net income of $290. Next, we add back expenses that didn't actually use any cash, like depreciation and a loss on a sale. So that's plus 45 and plus 5. Now we adjust for the operating accounts. So when accounts receivable went down, that means our customers paid us, so we add that $60 in cash. When salaries payable went up, it means we held on to our cash instead of paying it out, so we add 50. But when inventory went up, we spent cash to buy it, so we have to subtract $30. And when accounts payable went down, that means we paid our suppliers, so we subtract 82. You do all the math, and bam, our net operating cash flow is $338. See? Every single step has a logical reason behind it.
Okay, so we've looked at the engine room, the day-to-day operations. But that's not the whole story. The other 2 sections, investing and financing, tell us about a company's big strategic moves. Are they making big bets on the future by building new factories? Are they raising cash from investors? Or are they paying down their debt? This is where we see their long-term strategy come to life.
The difference here is actually pretty clear once you see it. Investing activities are all about using cash to buy long-term assets that are going to help the business grow, down the road. Think of a company buying a new building or selling off some old machinery. Financing activities, on the other hand, are all about how the company gets its money in the first place. This means dealing with its owners, like selling stock, and its lenders, like taking out a new loan or paying one back.
Okay, exam alert. For your test, knowing which bucket to put these transactions in is absolutely key. If the company buys a new factory, that's an investing cash outflow. If it gets money by selling new shares of stock, that's a financing cash inflow. But here is the classic trap question. What about interest payments on debt?
It feels like it should be financing, right? Wrong. Under the rules, it's considered a core cost of doing business, so it actually goes in the operating section. That's a huge point you do not want to forget.
And this, right here, is where the magic happens. It's so cool. When you take the total cash from all three activities, operating, investing, and financing, and add them up, that final number has to exactly match the change in the company's cash on its balance sheet from the first day of the year to the last. It's a perfect, airtight story. Every single dollar is accounted for.
So, we've pretty much mastered how to read the story of what a company did with its cash in the past. But how do they decide where to spend their money in the future? Well, that's where capital budgeting comes in. This is basically the toolkit managers use to answer those huge multi-million-dollar questions like, should we build this new factory? Or is launching this new product really worth the investment? It's all about making smart bets on the future. The first tool in the kit is the simplest one, the payback period. This is less about how profitable a project is and way more about risk. It asks just one simple question: how long until we get our money back? So, if you're choosing between two projects, the one that pays you back faster is usually seen as the safer bet. It's pretty intuitive.
But, just getting your money back isn't really the goal. You want to create value. And that's where a much more powerful tool, net present value, comes in. NPV is brilliant because it's built on a simple truth. A dollar you get 5 years from now is worth less than a dollar you have today. So it takes all the cash a project will make in the future, figures out what that's worth in today's dollars, and then subtracts what you have to pay for it. The rule couldn't be easier. If the number is positive, it's a green light. The project will make the company richer.
Our final tool is the internal rate of return, or IRR. Now, if NPV tells you how much value a project creates in dollars, IRR tells you the project's return as a percentage. You can think of it like the interest rate you're earning on that particular investment. And the decision rule here is also super straightforward. You just compare the project's IRR to the minimum return your company needs to make. That's often called the hurdle rate. If the IRR is higher, you've cleared the hurdle, and it's a good investment.
Okay, we've covered the key concepts of cash flow. We've covered capital budgeting. Now, let's bring it all home. Let's get tactical and talk about how to apply all of this to absolutely ace your exam. Here are the top tips to make sure you walk in there feeling confident.
First, go back and master the fundamentals. Review your lecture slides and all those in-class problems. Second, and listen, this is probably the most important tip. Treat the practice questions on Canvas like the real thing. Set a timer, no notes, don't you dare peek at the answers. It's the only way to know what you really know. And finally, don't try to do this all alone. Your TAs are your best resource. Hit up their office hours. That's what they're there for.
So, let's go back to our mystery from the beginning. Who was the healthiest company? Well, now that we know what to look for, the answer is just staring us in the face. It's Walmart. And the key clue is right here: a massive $28 billion positive operating cash flow. Their main business is a cash-generating machine. And Uber and Sears? Well, they were actually burning through cash from their core operations. The only reason their cash went up was because they were raising new money from investors. And as we know now, that's not a sign of health, that's a sign of a company that's just trying to survive.
So, now you see it, right? The statement of cash flows. It's not just some boring accounting document. It's a story. It's the real story of a company's health, its strategy, and its future. You now have the key to unlock that story for any company in the world. So the only question left is, whose story are you going to read next?